Beijing is grappling with a mounting debt crisis. 54 trillion at the end of 2022.
This is the story of a huge change in the Chinese economy.
Unrest is growing in China. Fresh protests have broken out in major cities with hundreds rallying, chanting.
Have you ever seen a ghost? Not the spooky kind, but something almost stranger. This is one of China's infamous ghost cities. Entire metropolises built for millions, yet inhabited by just a few thousand. It looks like a colossal waste of money, a city built for a future that never arrived. It begs the question, who paid for all of this? And more importantly, why? For decades, the world has been captivated by two narratives about China. First, the story of its economic miracle, lifting hundreds of millions out of poverty. And second, the story of China as the world banker, the disciplined saver that buys up trillions of dollars of other countries' debt, especially America's.
Look at this chart. Highest debt to GDP ratio countries, you will see Japan, US, Greece, Italy and others. As compared to these countries, if you look at China's official debt to GDP numbers, it is sitting comfortably below 100%.
But the story of these ghost cities reveals a third, hidden narrative. It's not a story of lending, but of borrowing on a scale that is almost impossible to comprehend. The common perception of a frugal China bankrolling a spendthrift America is dangerously simplistic. The truth is, the most indebted entity might not be the one you think. Today, we're going to look under the hood of the Chinese economy to understand its monumental debt problem. It's a story about hidden borrowing, a relentless obsession with growth, and a system that has pushed the country into a perilous corner. The first and most obvious crack in China's economic facade is its property market. You've probably heard the names, Evergrande, Country Garden. These property giants, once symbols of China's unstoppable rise, have come crashing down under mountains of debt. But this isn't just about a few mismanaged companies. The Chinese real estate sector is the single largest asset class in the world. For generations, it was seen as the only surefire investment for ordinary Chinese families to park their life savings. This belief fueled a speculative frenzy that sent property prices into the stratosphere. The result? A severe and prolonged downturn. Since 2020, the sector has been in a state of crisis, impacting household wealth and consumer confidence. In most months since late 2023, over 90% of China's 70 major cities have reported falling home prices month over month. This crisis is a direct consequence of the debt that funded its unsustainable boom. And it's the most visible symptom of a much deeper problem. To understand how these ghost cities and unaffordable apartment blocks were financed, you need to understand that Chinese official government debt figures are just the tip of the iceberg. The real debt is hidden in a complex three-layered system, like a giant Jenga tower. First, there's the official debt. The International Monetary Fund, IMF, reported China's general government debt was around 77% of GDP in 2022. While rising, this number doesn't look catastrophic on its own. But this is where the deception begins. The first hidden layer is something called local government financing vehicles, or LGFVs. For decades, local governments in China were officially restricted from borrowing money directly, but they were also under immense pressure to generate economic growth. Their solution was ingenious and dangerous. They created thousands of separate companies, these LGFVs, whose sole purpose was to borrow money off the books to fund infrastructure projects. This debt is technically corporate debt, not government debt, yet everyone knows it's implicitly backed by the government. How big is this hidden pile? Estimates vary, but many place the total debt of LGFVs at a staggering $8 to $10 trillion. Some analyses suggest this debt alone is equivalent to nearly half of China's entire GDP. The second hidden layer is the debt held by state-owned enterprises, or SOEs. These are the giant corporations that dominate China's economy, from construction and engineering to banking and telecommunications. They act as arms of the state, tasked with carrying out national strategic goals. To do this, they borrow. A lot. According to the OECD, SOEs account for over 3/4 of China's non-financial corporate debt. S&P Global estimates that corporate debt in China reached nearly $29 trillion in the first quarter of 2022, with a huge portion attributable to SOEs. Again, while technically corporate debt, if these strategically important companies were to fail, the government would almost certainly be forced to step in. And what holds this entire structure up? The third layer, a state-controlled banking system. China's major banks are directed by the government. They are instructed to lend to the LGFVs and SOEs, creating a closed loop where the state essentially borrows from itself. Money is created and channeled not necessarily to the most productive ventures, but to where the party directs it. When you add up these layers, official government debt, LGFV debt, and SOE debt, the picture changes dramatically. China's total debt-to-GDP ratio is likely well over 300%, a figure that would signal a severe crisis in almost any other economy. So why did China build this precarious Jenga tower of debt? The answer lies in the political mandate of the Chinese Communist Party. For decades, the party's legitimacy has been built on a simple promise. We deliver rapid economic growth, and in return the people accept one-party rule. Local officials are promoted based on their ability to hit GDP growth targets. And what's the fastest, most direct way to boost GDP? Build something. A highway, a bridge, a new city district. It doesn't matter if anyone uses it. The act of spending and construction itself juices the GDP numbers for that year. This created a perverse incentive to favor massive, debt-fueled investment over everything else. This model has led to an incredibly lopsided economy. In most developed countries, household consumption makes up the majority of the economy. In China, it's a far smaller share. The system was built to produce, not to consume. Now, the government knows this is a problem and is trying to shift towards a consumption-led growth model. But it's like trying to turn an oil tanker on a dime. You can't just tell people who have been saving frantically for decades to suddenly start spending, especially when their main asset, their home, is losing value and they fear for their jobs. With a debt-to-GDP ratio of over 300%, a deflating property bubble and weak consumer confidence, the situation looks dire. So why hasn't it all collapsed? This is where we get to the China is different argument, and it has some merit. First, unlike the US or European countries, most of China's debt is held internally. One part of the state, an LGFV, owes money to another part of the state, a state-owned bank. In theory, the central government can order the banks to roll over these loans indefinitely, preventing a cascade of defaults. It's a family affair. Second, the Chinese state owns a colossal portfolio of assets. It owns all the land, the major utilities, and the largest companies. Unlike the US government, which has a negative net worth, the Chinese government has a massively positive net worth. If push came to shove, it could sell off these assets to pay down debt. Third, China has strict capital controls. It's very difficult for citizens or companies to move large amounts of money out of the country. This prevents the kind of capital flight that triggered financial crises in other emerging markets. These factors give the Chinese government a level of control that Western governments can only dream of. It can orchestrate what some call a controlled demolition, rather than allowing an uncontrolled collapse. China's economic miracle was built on a foundation of debt-fueled investment. That model created the gleaming cities and high-speed rails we see today, but it has reached its absolute limit. The returns on new investment are diminishing. Building a second airport for a city that barely uses its first doesn't generate real productivity. This leaves China facing a profound dilemma. It must transition away from its old model towards one driven by domestic consumption. But this transition is fraught with risk. It requires deep, structural reforms that challenge powerful vested interests and could lead to a period of much slower growth, the very thing the party has staked its legitimacy on avoiding. So, will China collapse? A sudden Lehman Brothers-style implosion is unlikely. What's far more plausible is a long, grinding period of stagnation, often compared to Japan's lost decades, but with uniquely Chinese characteristics and far greater social and political risks. The story of China's debt isn't just about numbers on a spreadsheet. It's the story of a nation that achieved an economic miracle by building a Jenga tower of risk. And now the whole world is watching to see if they can remove the pieces without toppling the entire structure.